Welcome, this is Group E1, and in this video we'll talk about venture capital. We'll talk about its definition, the main investments goals, the types of assets, the main players, and its relevance in the economy. Without further ado, my colleague Adriana will now start with the definition.
Venture capital is a form of private equity in a financial operation by which investors provide capital to startups, companies, or small businesses with the potential to grow in the long term in exchange for an equity stake. With the form of private equity, we mean that venture capital, as private equity, consists of the creation of a fund of 5 to 10 years that is then sold in order to have a high return and liquidity. The venture capital fund will buy a stake in these firms, nurture their growth, and look to cash out with a substantial return on investment. The exit or disinvestment period is when the startup has grown, has been revalued, and shareholders sell its shares at a higher price to a major group of shareholders. Consequently, the fund closes. Regarding the relevance of return, liquidity, and risk, we could say that risk and return management is one of the core competencies of venture capital companies, as they invest in young, innovative firms with a high return potential but also high risk potential. Due to the liability of smallness, newness, and financial constraints, young, innovative firms are constantly under the threat of failure. Assessing and managing risk is therefore a major task of venture capital companies. Obviously, the return to the venture capitalists depend upon the growth of the company. And regarding the minimum investment, venture capital firms have a minimum investment in order to participate in their fund. In general terms, this minimum usually begins at $1 million, but is often $5 to or $10 million. The minimum is dictated by the fund, and generally the more successful the fund, the higher the minimum. Regarding the liquidity constraints, a venture capital firm needs to raise a lot of investor capitals. With this money, the fund is able to buy different companies, participatives, in order to sell them in a period of 5 to 10 years, depending on the fund and the target company. Venture capital does not see any liquidity until the sale of the fund or the sale of the participation in the company. The investment goal is, first of all, to generate company's growth by, for example, increasing its sales. Secondly, increase its generated cash flow so that reduce costs. And finally, optimize its balance sheet, as for example, reduce the working capital and the fixed assets. Moreover, we could also consider other important aspects that increase the company's value, such as the improvement in technical know-how, brand awareness, recognition, client portfolio, among others.
We'll now move on and talk about the different types of assets. So generally, venture capitalists invest in seeds or early stage startups where they identify companies with cutting edge technological innovations and factors that show signs of potential growth. The management team usually tries to focus in building a diversified portfolio of innovative companies and diversifying an appropriate risk. Some of the key elements that VCs take into consideration in the selection process are the following. So you have competitive advantage, the overall potential of the industry, the expertise of the founding team, and the improvement capabilities of management. Charlotte will now take over and talk about the key players that interact in venture capital.
Venture capital firms are usually organized as limited partnerships, where you can find two types of partners: general partners and limited partners. General partners serve as investment professionals. They decide which ventures to invest in and are generally the ones that take a board seat post-investment. They will therefore usually charge a management fee and a percentage of profits. Limited partners, however, do not concern themselves with the day-to-day running of a VC fund, but they have to put up the capital for the investment. This is why they only receive their proportionate share of benefits from target companies. This party is usually high net worth individuals, institutional investors, and family offices or corporations. Therefore, venture capital firms seek to obtain minority shares and a chair on the board of directors with the idea of retiring in a body of time and thus obtain a profit and profitability. When we look at the involvement that VC funds have with the firms, we see that VCs would like to have a clear involvement with the company they invest in order to stay close to their investment and to have a say in major decisions that could impact their returns in the long run. This involvement is done through the board, where they can take one out of two roles. Either they could be a board member or board leader which includes participating in major decisions in the company, working with management and on strategy, giving advice, participating in voting, etc. Or they could be a board observer, meaning they still have an open invitation to attend meetings without a vote. However, this role still does come with a lot of influence.
Moving on to the relevance of the investor in the economy. Venture capital funding can be crucial for the fate of new businesses. It allows them to invest heavily on R&D, and that is why venture capital-backed companies are among the most innovative. As previously mentioned, the intention of the investors is to increase the value of the companies in order to then gain capital themselves by selling its shares. It can make the difference in terms of generating revenue and growth for a company or making them shut down. Therefore, venture capitals are needed as they are an important source of capital for the startups to survive, and these new startups are a significant factor of contribution to establish growth and innovation within the economy as a whole. The exact influence of venture capital on the economy's GDP is uncertain. What we know at a corporate level is that economic growth results from existing firms' growth, but also from the formation of new ones. It is as simple as the more startups get formed, the more the employment rate rises, and it impacts the economy in a positive way. For example, the thriving entrepreneurial communities of Silicon Valley owe a lot to the venture capital industry that was established. And various innovative companies that are now very well known were once venture capital backed up companies, such as Microsoft, Apple, Google, Facebook, and Alibaba. As well as, among the well-known venture capitalists are Jim Breyer, an early Facebook investor, Peter Fantin, an investor in Twitter, and the co-founder of PayPal, and Facebook's first investor, Jeremy Levine. Additionally, we can say to conclude that venture capital investors play an important role in impacting positively the economy.
And before concluding, we wanted to put the theory into practice and listen to Nicholas, a current investor in AXA Investment Managers.
I'm Nicholas. I'm an investor at AXA Venture Partners. We are managing a $1 billion fund to invest in startups, typically at the stage where they have customers, they have at least a few millions in revenue. So you have some data on whether the company is growing. You can ask customers, why they're buying the product, what's great about, exactly their product. All the businesses are in the technology industry. So what we're looking for typically in companies is there something unique about the technology that they've built? How difficult is it to replicate the technology that they have? So those are two key elements of the defensibility of an investment. And then the other things that we're looking for typically are, good metrics. So strong financial metrics, and that could mean, revenue growth, how much sales and marketing investments they're doing to attract new customers. So typically we look at, how much you're spending in sales divided by how many customers you're acquiring. And that's like a cost to get a customer. And then, we look at how much are the customers paying you to get, what is the typical return profile of a customer and how profitable is the customer acquisition engine of that company. So most of the companies we look at are actually loss-making. But since all the money that they're spending to acquire customers will turn out profitable in, say, 1 or 2 years, then it's still worthwhile to spend all that money to grow the business because there's a path to profitability down the line. I spend most of my time talking to companies, figuring out what is the secret sauce of the company. How attractive is the market? Is it large? What is the competition? And so forth. What is the product and technology? What does the financials and metrics look like? Is this a strong team? Have they created businesses before? Do they have relevant industry expertise? and so forth. And then last but not least, the deal. If you're buying, too high of a price when you're coming into the company, it's more difficult to make a good return. And the return that we're typically targeting is 25% per year IRR.
That's it. I hope you've enjoyed our video and learned a bit more about venture capital. And if you have any questions, you can always ask us.